Hello, Olivia here from Urban, and today I'm joined by Vincent Turner, who's the founder of the Australian firm Uno Homeloans. Today, Vincent's going to share with us some practical tips to help you manage your mortgage through the pandemic. Vincent, welcome and thanks for joining us.
Thank you. Awesome to be here from our respective abodes, wherever that is.
Yeah. So would you mind explaining Uno's role within the finance industry and I guess some of the ways that you've helped Australian homeowners?
Yeah, absolutely. So, we started life about 4.5 years ago as what I would call an online mortgage broker. My background's technology. And then we actually, a couple of years ago, were like, you know what, it's just not enough just to be online. So we repositioned the business and built all this capability around this idea we call active home loan management. And the premise is really simple, which is most Australians don't really take care of their home loan. Once they've done it, they're like, all right, I've done that. And they sort of put it in a box and forget about it. And we sort of did some analysis on that and found out that was costing every year Australians collectively between $4 and $8 billion. And our premise is if you were actively managing it, like if you were staying on top of this, you wouldn't be spending that money. But you won't do that. So give it to us and we'll do that for you. And so the whole proposition of Uno is one of being on top and staying on top of it. And it's a technology and people proposition.
Wow. So Australians are spending $4 to $8 billion in unnecessary interest payments each year. Is that correct?
Yeah. And look, it's funny because most people don't think of it as a form of waste. But last year you can still find it online. We released a thing called the Household Wastage Report. And we ranked all of the waste, like gym memberships that you never use and food that you throw out. And home loans were the second largest form of wastage after food. And when you sort of reframe it in that term, it's like, why am I wasting all this money? And the example I like to give to people is, imagine every single month, like you did, like what I just did this morning, you broke your phone and it cost you $150 to repair it. If you did that every month, you'd be like, oh, I'm so angry at this. Yet that's what people are doing with their mortgage every month. Every month they probably overspend maybe $100, $150, depending on the size of your loan amount, and they do nothing about it. So we're trying to reframe that issue.
Yeah. So I guess now what people want to know is how can you negotiate a better rate with your current lender?
Yeah, it's just I think the starting point is knowing whether you're on a good loan or not. And part of the problem in the market is that there's so many products and rates and not everyone gets everything. So just seeing a thing on a billboard doesn't help because you're like, well, I don't know if I get that. So the first thing we did actually build a technology called LoanScore that says, tell me about your loan and tell me a little bit about what you want. If you only want to deal with the majors or you don't want to deal with the majors or you really want an offset, tell us some of those things. And then we turn that we got this special algorithm, like our own technology, that turns that into a score out of 100. And it pairs that with a net savings of how much you could save if you changed banks or how much you could save if you just got a better deal with your current bank. And then what customers can do with that technology, that's totally free, that tech, it takes about 1.5 minutes to sign up, is that they click a button and it comes through to our team and our team can have a conversation to say, okay, we've had a bit more of a look and a chat and we could help you get a better loan with your current bank. And either we coach the customer and say, hey, here's how you need to frame this and here's what you should expect. Or in a lot of cases, customers are like, I'm not even comfortable having the conversation, even if I knew how to have it. So can you do that for us? And in those cases, we actually do that on behalf of the customer.
That's a great service. So what would most customers score out of 100 be when they first sign up?
Oh, that's a good question. I haven't looked at those scores at aggregate lately, but when I last looked a few months ago, about 20% of people have what we call a green score, which is kind of in the high 80s or 90s. And it means they can probably save a couple of percent a year. But after costs and effort, it's like, you know what, you're fine. You could be getting a little bit better deal, but just don't worry about that. Like go and live your life kind of thing. The next sort of 20% are in the orange zone, which is you could probably save between 5 and 10% a year in your interest. And like you should, this is money for jam. It's not that much effort. At the bare minimum, at least get a good deal from your current bank, even if you can't be bothered changing. And then the rest, like 60, 70% are in the red zone where it's like, you could be saving thousands, if not tens of thousands of dollars, even just over the next 3 years. And the tech actually takes into account the cost of switching. It's like it's not free to switch loans. You've got to pay out the old one and then there's some fees and then there might be like the lender might give you a cash back and it calculates all of that and says, our estimate over the next 3 years is this is net of all that, this is what the cost would be. But it's roughly 20, 20, 60.
Yeah. Okay. So
most people.
Yeah. What advice would you have for people who are perhaps quite worried about them managing their mortgage through the pandemic?
Yeah, look, I think the things that blindside you where, you just, like, I was going to lose my job and I just didn't even see it coming. Other than taking out something like income protection, which is a whole other story, there's not too much you can do with that. But the two things you can do proactively if that's worrying you, one is to be really on top of where you spend your money, so that you have higher affordability of the loan that you have. Looking at your discretionary spend, consolidating debt. If you've got equity in your house and you've got like I've got a personal loan, and I just found out today it's like a 13.19% interest rate, and my home loan is 3%, right? So actually, it doesn't even make sense to have those two. You should, you pay off the high ones or pay them out. So consolidating debt, and then the second thing as well, I would say is, if you are in a period where you do have a job and you're paying your loan and you're affording it, do your best to put a bit aside, so that if for some reason you had to take a few months where you didn't have a job and you were having to look for another job, not only will you should be able to get the benefit of some hardship assistance from the banks, and I think a lot of customers don't know you can do that, but at least it gives you a buffer to be able to manage that in the interim.
Those are some great tips. That's really helpful. And so I know there's probably no magic answer for this, but are there some tricks for helping pay your mortgage off quicker?
There's heaps of tricks. No, I think there's some things that we don't tend to think of because they seem too obvious, right? And some of them are obvious, right? Making extra repayments is the single smallest lever that people can do. And it can be small. Like, people are like, oh, well, what difference does it make if I pay an extra $50 off a month? A lot. It doesn't make a difference now. In fact, it feels like it's $50 coming out of your pocket. But your interest in the last 2 or 3 years, it basically gets rid of that interest. And so even over a period of a 20-year loan, even an extra $50, $100 a month can have a massive, massive impact. So that's one. The other one, I think, that's a really good one for people to do to make it feel like that they can afford not only to make their repayments, but even make extra repayments, and I do this, is to line up when you pay your mortgage with when you get paid. And so, for example, I get paid in the middle of the month. I get paid on the 15th, and my mortgage, and in fact, all of the things that I have to pay, not just my mortgage, but I put $200 aside for savings as well, which we'll talk about in a sec. And all of those things come out 2 days later or 3 days later. So there's not a mistake on a long weekend. And it means I never see that money. And so every month I pay my mortgage and I make an extra repayment and I put a little bit aside. And then I have not a lot of money to live on for the rest of the month, but that I can manage that because I look at my bank account and go, okay, well, no shoes this month because I can't afford to buy the shoes. And I think that actually really helps you stay on top of your mortgage and pay it off faster. And then the other point that I made about paying off debts faster, there's a concept called snowballing, and that means you pay the thing with the biggest interest rate and you pay that off fastest. Like, any extra money you have, pay the minimum off your mortgage and the minimum off your car loan. If you've got this other card here that's at 19% like a credit card, pay that first, and then once you've stopped paying that one, then pay the next one and snowball your way down through your debt that way.
Absolutely. So you mentioned your divvying up your salary when you receive it. Is there a certain percentage that you should be putting towards your home loan?
Yeah, that's a good question, because I think if the only thing you had in the world was a mortgage and you wanted the monkey off your back, then you would say as much as possible. And I know there's a great book that you can read, and I think they've got an online course as well called The Mortgage Mutilator, of all names, and they actually recommend paying 70% off of your after-tax salary. Now, that's a lot, because that means you literally have no other debt and you probably don't have private school fees or a car or any of those other things. But part of what they're saying is work out how to live with a lot less things. I actually don't own a car, for example. I'm on an okay salary, but don't own a car. I'm having to buy one at the moment. But the point being is that if you can take a lot of the cost out, then you have money left over. The general rule of thumb for whether you can afford a mortgage is kind of a third for you, a third for the mortgage, and a third for the tax man. And that rule of thumb still holds pretty true today. If you're having to spend more than 40% of your income on your mortgage, you're probably having to do it, then you're stressing. So I think somewhere in that order of magnitude.
So what are your top 5 financial rules that every homeowner should live by?
5? I'm going to have to come up with 5. Okay, so in terms of the mortgage specifically, I think There's never paying interest only on a mortgage, even for an investor. Like, some might consider that investment advice. It's not specifically that. The point being is, if you can't afford to pay the principal, you probably can't afford the mortgage. And if something goes wrong, then you'll stress yourself. Understanding and keeping on top of your interest rate, and that's hard to do. You've got to sort of watch your bank, or you can use LoanScore, will help you at least to understand whether that's any good. So taking a more active interest in that. I think really understanding discretionary spend. I think so many people, don't get their head around things like spending $60 to buy to get Uber Eats. No offense to Uber Eats or any of them, but it's a really expensive way to eat, and it takes very little effort to buy food and learn how to cook. And that might sound counterintuitive from a homeowner expense perspective, but it's a massive, massive lever. The food that you ate for $60 would probably cost you $11 to make, and you'd probably prefer it, to be honest, once you know how to make it properly. I think for anyone who has a house, maybe not an apartment, solar and potentially even solar storage is pretty much a no-brainer. There's grants out there to help you get it. In fact, a lot of local councils have grants as well. But the cost of solar at least, I know there's a company called Amber that lets you get wholesale electricity at the wholesale price, and then you get to use your solar and combine those two, and it takes like 40% off your electricity bill. So there's really creative ways you can go out there to save money. And then the last thing I'd say, which is probably highly relevant in these times, is that your home can be a wonderful place to spend time in. And if you're spending time at home, often you're not spending money. And so if you want to actually run lean, make your home a place where you love to spend time and have people over. And that's a really cost-effective way to have a wonderful life as well.
Yeah, definitely. And I'm sure everyone's learned how to spend time at home during the lockdown as well.
Yeah, exactly. We're all getting a lot better at that.
Yeah.
Maybe too many Zoom calls, but that's okay.
Yeah, so many Zoom calls. Awesome. Well, thank you so much for sharing all your advice today. I'm sure it's going to give a lot of homeowners that extra confidence they need.
Yeah, absolutely.
If you like this video and want to learn more property tips, then subscribe to our YouTube channel. And as always, feel free to leave any questions in the comments below.